My humble greetings to fellow colleagues and executive members of the board. On behalf of the financial department, we would like to welcome you to the potential launch of Crest White Strips Advanced Seal.
P&G prides itself on innovation as well as growth in a sustainable manner through several dynamics, and they are ever ready to expand their already vast global product listing of consumer goods.
We have done a comprehensive financial analysis testing the profitability of the proposed launch of Advanced Seal, and these were our findings.
The overall assumptions throughout the analysis, all final rates and monetary amounts are rounded up to 2 decimal places. The project lifespan is 4 years. We assume a current financial position as at Q1 2019. Tax rate is 40%. All unit volumes were rounded up to the nearest whole number. All revenues, rates, and cash flows are in real terms. The direct exchange rate for 2019 Q1 was calculated as 14 Rand 86 to the dollar. All assets are depreciated using the straight line method. The market value of the firm amounted to approximately 1.2 million Rand. The cost of equity, 10.39%, the cost of debt, 34.32%, and the cost of preference shares, 30.95%. Taking into account these various costs, once plugged into the formula, indicated a weighted average cost of capital of 14.54% in real terms. The NPV base case sees a gross profit annually yielding $22 million. We assume a $6 million fixed marketing budget payable at the end of the launch and every year thereafter. We expected to incur $2 million in startup costs in year 0 as they learn the new technology. We expected to incur $1.2 million in one-time labor costs to launch the product, also in year 0. We require an initial year 0 investment in net working capital of 1% of year 1 sales, which will be fully recoverable at the end of the project. After-tax erosion yielded to $1.02 million. The conventional method was used in order to calculate the operating cash flows. The NPV of the base case with a lifespan of 4 years was calculated. The cash flow from activity shown in the table is converted to rands and is discounted at the weighted average cost of capital to produce an NPV of approximately 163 million Rand. The accounting break-even is the number of units which need to be sold in order to balance depreciation and fixed costs. The accounting break-even is indicated as 750,000 units. Unfortunately, the accounting break-even devalues the actual cost of recuperating the initial investment. Therefore, the present value break-even is calculated at 981,341 units. The compilation of the profit and loss statement for the lifespan of the project, taking into account that this is still the base case, predicted $6 million annually, which is approximately 89 million Rand.
After much deliberation, we managed to create a total of 7 alternative scenarios to the base case. Some key causes that affected the scenarios are the different advertising options, different methods of implementation, as well as the introduction of the new technology, all of which will be discussed in greater detail as I proceed. The changes that I'll be mentioning occur against the base case values unless stated otherwise. Along with each scenario is the respective NPV percentage changes against the base NPV. Under scenario 1, there is an increase to the advertising budget by $4 million in year 1, which results in an increase in the number of units sold. The table on the right of the screen depicts the cash flows from financing activities along with the NPV. After taking the aforementioned changes into account, we notice an 8.08% increase in the NPV. In scenario 2, this is where it starts to get interesting as we look at the idea of introducing new technology in the initial year of the launch in the form of machinery to bolster production, and we assume it is accepted. This introduction of new technology brought about a subsequent increase in the number of units sold in year 2 to 4, resulting in a sales price and cost of goods sold increased price per unit by $1 and $2 respectively. Depreciation amounted to $375,000 as shown in the table. The total value of the new technology is $1.5 million, which is accounted for under the initial year of the project. With regards to cannibalization, there was an additional 450,000 units of premium products being cannibalized. In scenario 2, after taking all the mentioned changes into account, we see a 4.24% increase in the NPV. In scenario 3 and 4, we will be looking at building on scenario 2 changes to the number of units sold, the price changes per unit of sales, as well as the cost of goods sold. and the new technology will still be assumed to be accepted. In scenario 3, we have the higher trial, high cannibalization method. If you look closely, you will notice that the units sold in year 1 to 4, that they are cumulative unit increases, which is over and above that mentioned in the previous scenario. The advertising budget for year 1 sees an increase against the base value. Cannibalization saw large increases to the base values for both premium and base products. This method had led to a 38.59% increase in the NPV. Now we look at the lower trial and lower cannibalization method. If you look at the table depicted, you will notice that in year 1 to 4, there are cumulative unit decreases that are over and above that which is mentioned in scenario 2. Under this method, advertising sees a decrease in every year. Both the premium and basic product cannibalization revert back to the base values. This implementation method saw a 51.62% increase with regards to the NPV. Looking at scenario 5, we move away from the previous 4 scenarios. We still assume that the new technology is accepted in the initial year in the form of machinery, but now we believe that it results in an increase in the number of units sold from year 2 onwards. The sales price and cost of goods sold increased by $2 per unit respectively. The depreciation and value of the new technology remained the same as previously mentioned. There were additional premium products being cannibalized in this scenario. Once taking all of the mentioned changes into account, we get a 2.09% decrease to the NPV. In the following 2 scenarios, we are building on from scenario 5. In scenario 6, we're implementing the higher trial, high cannibalization method on the previous scenario. You will notice that the units sold in year 1 to 4, there are cumulative unit increases, which is over and above that which is mentioned in the previous scenario. The advertising budget saw an increase for the 4 years. Again, under this method of implementation, we see the high cannibalization because against the base case value for both the premium and the base products for the 4 years. Overall, this implementation method produces a 41.08% increase to the NPV. Lastly, we look at scenario 7. Here we are implementing the lower trial, lower cannibalization method. Looking at the table, you'll notice in year 1 to 4, there are cumulative unit decreases, which is over and above that which is mentioned in scenario 5. Advertising decreased by $1 million each year. Because this is the lower trial, lower cannibalization method, we saw both the premium and the base products cannibalization revert back to the base values, resulting in a 43.73% increase in the NPV.
A sensitivity analysis was done to test the sensitivity of the base case NPV to changes in the 5 main variables, namely the sales unit, selling price, cost of goods sold, advertising, and cannibalization. The results of the analysis show that the NPV is most sensitive to changes in the selling price and cost of goods sold, such that a 10% increase in the selling price increases the NPV by 69.37%, while an equivalent increase in the cost of goods sold decreases the NPV by 37.84%. The feasibility of the scenarios presented here were tested using the NPV method, which returned favorable results throughout. These results were further validated by the profitability index, which also indicated that all of these scenarios have potential to create value for P&G. Notably, 4 out of the 8 scenarios presented returned profitability indices which are greater than 4, which means that for every dollar invested in either one of these scenarios, P&G will stand to gain approximately $3 in additional value. Overall, scenario 4 returned the highest NPV and profitability index. This scenario suggests that P&G will have to include the new technology in advanced sale. This will have to be coupled by a $1 increase in the selling price, a $2 increase in the cost of goods sold, and a $1 million decrease in advertising cost. In order for P&G to maximize shareholder wealth, we recommend the advanced sale launch in the United States as per the strategy outlined in scenario 4.
With the following analysis completed, it is hoped that the executive board members are able to take a decision with much ease that will benefit shareholders, employees, and the customers of P&G as a whole. We thank you.